Good afternoon and welcome everyone to today's US market update and bulls versus bears review. Great to see so many of you guys on today's webcast. My name is Kelly Main, Associate Portfolio Manager, and with me today are Portfolio Managers Stephen Lyle and Chris Wallerman. We welcome question and answers throughout the presentation. Please feel free to click on the question and answer tab at the bottom of your screen to ask a question. We will do our best to answer it in a timely manner and as best as we can. So before we get started, I'll just read the necessary disclosures. Today's webcast is general advice. The advice has been prepared without taking into account the client's objectives, financial situation, and needs. Clients should consider the appropriateness of the advice by taking into consideration your objectives, financial situations, and needs before acting on the advice. A copy of the disclaimer can also be found on our website at www.fortran.net.au. With that, I'll now turn the presentation over to Stephen Lyle.
Thanks, Kelly, and thanks everybody for coming out today. 40 million people in the US are unemployed. There are riots in the streets. We're in the midst of the worst economic downturn that we've seen since the Great Depression, and yet the market continues to rise, up 7.5% in the month of May. And that's really indicative of investors' expectations for 2021 earnings. Investors are looking past the rest of the year, really. We see some green shoots with the opening of the economy following the COVID restrictions, so there's some easing there. And just as things were beginning to open, stoked by racial tensions in America, we saw the terrible riots and looting, along with some peaceful protesting as well. But make no mistake about it, these riots and looting are much more related to 40 million people not having a job to go to tomorrow than to any sort of racial tension. That is compounded, of course, by the race issues in America that have been around for a long time, as well as a media that's feeding into the frenzy and a president who is not known for being a unifier in chief. But as a pricing mechanism, the market is pretty efficient. So we have to listen to what it's saying to us. And right now, we've seen just tremendous performance on the back of very bad economic fundamentals. This divergent situation is concerning to us, but again, as I said, I think that it's much more about next year's earnings than about this year's. So moving to market performance, we saw the S&P 500 up 7.5% in a month. Earnings estimates were actually cut 1.6%, which was a lower reduction than we anticipated. However, because of price surges, the average PE in the market rose 9.3% to 18.8, which is the highest level we've seen since the GFC, since prior to the GFC. And as I mentioned, this contrasts dramatically with the actual current economic data. And we're concerned about Brazil and India. China is another story. They seem to be on a faster recovery path than the rest of the world because of the way they managed the COVID outbreak. They're probably 8 to 12 weeks ahead of us. So if that's any indication of future demand, I think that's what investors are looking at and bodes pretty well for the economy moving forward past the second quarter. This quarter is not going to be pretty. Fortunately, in the 4-trend relative value portfolio, we're highly exposed to technology and healthcare stocks, which have outperformed the market. So even with our 20% cash position, our portfolio performed better than the overall market. These are the movers for the month of May. What we've seen towards the end of the month was a real rotation into industries and companies that were out of favor going into this COVID crisis. So we see home builders and some retailers surge. We see some commodities-related businesses like Cleveland Cliffs and Albemarle surge, and also some technology, as well as Royal Caribbean, which is surprising. On the downside, the oil patch. I think that in that market, we've seen a major deterioration in demand in conjunction with a huge surge in supply. And so that sector will have a much longer recovery, we think, until demand picks up from people driving again, frankly. Any questions on that, Kelly? Did you mention how people can ask us questions?
Yes, I do.
Okay. So throughout the presentation, we'll try to take questions as we normally do in person. Last month, it seemed to work out pretty well. So if you have any questions, please just type them in and we'll respond. I'm going to hand it over to Chris to discuss the relative value model.
Thank you, Steve. So looking at the relative value model, it's a way that we aggregate data for each sector, this slide, and represent the change in the prices, which it was broad-based strength for all sectors in the month. But some stocks that hadn't yet reported, particularly in the retail space, that have a later reporting period to help them work through those holiday season peaks like Christmas, they reported slightly later. And so we see some pretty significant cuts to the earnings forecasts among retailers. That was, having had the benefit of a lot of earnings already released, that was largely expected. So again, we're seeing investors look beyond the current year and forward to 2021 and beyond, where earnings are expected to improve. There's a lot of conjecture around the shape of that recovery, but and the timing. But the market is a forward-looking methodology and tries to incorporate those anticipated future improved earnings. Breaking down the market by sector once more, the regression analysis here, looking at the price per dollar of sales versus the return on sales or the profit margins. That slope represents the price-earnings ratio of the market. It's about 19 times forecasted earnings right now. And sectors that lie below the line, like autos or pharmaceuticals, are trading at a discount by that metric. And this is a good way to illustrate areas where there's discrepancies in the valuation. Some of that might be justified, but it's a quick way to illustrate it and a way for us to identify areas of interest for more stock-specific research. So looking to the bulls and bears, we'll review the bullish outlook among 3 strategists and the bearish outlook among 3 strategists before discussing our view. Interestingly, there's been a lot of changes here since the last bulls versus bears report 3 months ago. Notably, the forecast price targets for the S&P 500 at year end have not only declined slightly, but the range has blown out. And that's even more so for the forecasted earnings for the year. So the most bullish strategist now, Thomas Lee, who was the strategist at JP Morgan, now works at Fundstrat. He's forecasting the S&P to finish at 34.50 at the end of the year, and the earnings for the constituents to be $110. So that would give us a price earnings ratio of 31.4. That's forecasted earnings at the moment, but if that comes to be, it will be historical earnings by that time. The most bearish strategist is at Barclays with a 2,500 year-end price target, and that represents about a 19% decline from where we are now. The S&P 500 at 3,080. So Thomas Lee, 12% increase, and the most bearish looking for a 19% decline. 3 months ago, the average year-end price target was 3,355, so about 10 or 12% above the average today. And the consensus for the aggregate earnings was $172. So that is a very significant reduction in the aggregate earnings, but also quite a significant range that we've seen now, with a low from $110 and a high of $152. 3 months ago, the low was $165 and the high was $178. So these ranges in forecasts are reflective of uncertainty. And typically, more uncertainty would attract a risk discount. But there are other factors at play. So the market is really not trading on multiples of 2020 earnings. It's trading on multiples of expected recovered earnings in the years that follow. And in addition, there are other factors that affect stock prices, like interest rates. And they are used to discount future earnings or cash flows in most fundamental discounted cash flow and other valuation methodologies. And so they are having an upward effect on the present value of assets. So I'll kick off with the bulls. Thomas Lee at Fundstrat is advocating a barbell strategy of high-quality growth stocks, companies in the technology and cloud space. I would describe these as the sorts of businesses that offer a secular growth profile, somewhat independent of the current state of the economy, and those recommendations are consistent with some of those in our model portfolio, like Alphabet and Qualcomm and Intel. Some of these companies have themes that will underpin their performance, like an adoption of cloud computing or the proliferation of connected devices. And in some cases, this pandemic has been a catalyst for accelerated adoption of these technologies. So in fact, a beneficiary for some of those businesses. At the other end of the barbell, Lee recommends basically investing in the stocks that have been worst affected by this pandemic: financials, travel, retail, and he also delved into a bit more, elaborates on the financials recommendation. He expects the banks that while they made a lot of provisions for expected delinquencies and bad and doubtful debts in the first quarter, he expects a second wave of provisions. So that's something to monitor closely. Interestingly, post the first quarter earnings, some CEOs have been a little bit more optimistic, notably Jamie Dimon at JP Morgan, the largest US bank by assets, suggested that perhaps there was enough provisioning already. So time will tell, and that will be a function of primarily the employment numbers and the shape and length of the eventual recovery. The banking environment is also very different today versus 2008, where the economic crisis was compounded by very elevated regulatory costs and litigation expenses. And also today, banks are far better capitalised than they were in 2008. So they're in a less leveraged position and better able to withstand these types of crises, which was really the objective of all the regulation post the financial crisis in 2008-09. JP Morgan expect that the fiscal and monetary stimulus will outlast the virus. So very much relying on government intervention to support us through this difficult time. Discounting the current year's earnings, which I think is something the market is doing anyhow. Doesn't matter if it's $150 or $130. The idea is to remain focused on the path of the outbreak and the path of reopening, and looking to China and some of these economies and geographies that were earlier affected are now reopening sooner. They provide, their experience bodes well for other larger economies that are in the earlier stages of dealing with the pandemic. Again, expanding on this idea of discounting the current year's earnings, it's the monetary base, or the quantitative easing, this monetary support, I beg your pardon, which is driving asset inflation. And S&P 500 companies with asset-light business models are likely to be beneficiaries. So the economic data will continue to get worse, but that's to be expected. And people will eventually return to some normality. This is not forever. We're social beings by nature. We will need to return to a social lifestyle, and especially work. It's an economic imperative. The lower income jobs that were first to be lost will be particularly important to be regained, particularly as the consumer represents 70% of the economy. So in 1 year, quantitative easing will still be here. It will be supporting the economy, and the worst of the virus will be past us. JP Morgan warns, do not be left holding cash in the event that a vaccine is developed. That could be a significant catalyst for appreciation in stocks. And to Wells Fargo. Wells Fargo is one of the largest mortgage issuers in North America, I think accounting for 1 in 4 or 1 in 3 mortgages. So they have a little bit more of a Main Street orientation or focus. And they're advocating watching for the banks to get through their Fed stress tests before they recover. And similar to Thomas Lee at Fundstrat, I recommend owning large cap technology. The Fed's efforts are pushing investors out on the risk curve and resulting in stocks particularly with more debt or precarious financial position being more recent beneficiaries. So expanding the bond buying program to corporate debt has significantly positively affected more indebted businesses, enabling them to raise debt at more commercial rates at a time when they otherwise were being treated as very distressed propositions. The best case is that the economy returns to a pre-COVID-19 scenario, but Wells Fargo is not expecting a V-shaped recovery, and in fact, some sectors will not come back. And I suppose this speaks to one of our broad themes of the velocity of creative destruction. This experience has greatly accelerated that velocity of creative destruction. There are a lot of losers, but there are also a lot of winners. Right now, we're seeing risk is in favour. It's a risk-on climate, if you like, and despite that, some valuations are as cheap as ever. With this peak pessimism, Wells Fargo thinks that things can only improve. So perhaps the cuts to the earnings outlook and other metrics have bottomed and will build and recover from here, supporting improvement in the market. I'll hand to Steve to review the bears.
Okay. Barclays, Bank of America, and Citigroup are bears this month. The most bearish being Barclays, Maneesh Deshpande. His analysis is really centered on capital expenditure and the expectation that CapEx for corporations across America will decline by 15% this quarter and for the next 4 quarters. And that will have flow-on effects to the rest of the economy. And therefore, he views these the significant reduction in demand from corporations as a bellwether of general economic activity, and therefore that's the center of his bearish premise. He expects an L-shaped recovery, which basically means, well, he thinks we'll fall 19% from this level, but the expectation that the major fall happened in March and will be somewhat neutral from that point for the next 2 quarters, 3 quarters. He thinks the deepest cuts will be in energy, industrials, and materials, and I think you could also add travel and leisure to that list. The companies, as Chris mentioned, that are winners in this environment, because we've seen a rapid shift in consumer behavior, are communication companies, tech, and of course consumer staples. However, as we mentioned in the Fortran view, consumer staples saw a major uptick in demand for all sorts of products in the 2nd quarter. However, that probably won't continue. The run on toilet paper seems to be over. What else were people buying? Guns in America. The run on guns. Well, flour, yeah, these things. Now everybody's got it in their pantry or their closet or their gun safe. And why would they buy more at the same level over the next 2 quarters? Probably not. So technology is really the standout here. Moving to Bank of America. Savita Subramanian, who we respect quite a lot. Her analysis is always very thorough and in-depth. She points out that the 1st quarter was not as bad as feared. 9% of companies that reported saw a decline in earnings estimates, and 15% of companies that reported were lower than last year. However, the real pain, the real bloodletting will be in the 2nd quarter, where we'll see major bankruptcies, because the companies and sectors that are leveraged just cannot sustain these levels if demand does not pick up, and it does not appear that it will in the 2nd quarter. So some firms are going to go under, and that has a cascading effect, from creditors to suppliers to customers. So that underpins her more bearish sentiment on the market. She does not expect consumer discretionary energy and industrial firms to perform for the rest of the year, so those are on her bad list. We would generally concur with that, particularly consumer discretionary. A lot of people are going to be booking cruises in the 2nd and 3rd quarter, we don't think. Please feel free to interrupt me with questions. Happy to field those. Capital preservation, 20% of firms have suspended buybacks. So again, that has flow-on effects for general demand from investors who are not receiving the benefits of buybacks or dividends. So dividends slash 10%. 1/3 of companies have pulled their guidance completely for the rest of the year because there is so much uncertainty here, which which is why we're somewhat surprised by this relatively high PE of 18.8 that generally would indicate that there's more certainty around earnings estimates, and that's certainly not the case right now. Which goes to Chris's earlier point that it's the monetary and fiscal stimulus right now which is supporting the market entirely. So if you look at it on a relative value basis, equities still look like great value compared to the 10-year Treasury, which is trading below 1%. So your payback period on the 10-year is, what is it, 100 years? And your payback period in stocks is about 15 years. So on a relative basis, equities look like good value. And that's generally what happens when you have this kind of monetary policy, is that you see asset price inflation, which is what's happening right now. So this rally is completely driven by optimism about the recovery, but more importantly, by the aggressive monetary stimulus and Fed action that have taken place in the last 2.5 months. She thinks the V-shaped recovery notion is an illusion and expects turbulence moving forward. Wall Street sees a big rebound in 2021. So this year, as Thomas Lee said, it doesn't matter if the S&P earns $130 or $150. Investors are looking forward to 2021, where the average estimate is above the $161 that were earned by the S&P 500 last year. But Bank of America is not so optimistic with that outlook, considering the current economic situation. I'll move on to Tobias Levkovich. He's concerned about a second wave. And his analysis is really not so quantitative as it is anecdotal. I think sentiment maybe has improved a little in the market because people are talking about buying guns less. I don't know how sound that analysis really is, but take it for what it's worth. We've only had 2 weeks of lockdown reported in the most recent earnings announcements. So the first quarter really accounted, the actual lockdown accounted for the second half of March, whereas the second quarter will account almost entirely of a lockdown period. And so we'll see a significant decline in sales and earnings for most sectors. The one exception, of course, is technology and healthcare. Oh, we've got a question. So even the bears are looking beyond today to a good recovery. So Michael Feeney, yes, yeah, that's right. Even the bears are reaching for something optimistic to say. In the Tobias Levkovich report, it's these anecdotal sort of impressions that sentiment is improving because people are talking less about buying guns. That's maybe a point of concern for us. But honestly, I don't think it's that relevant, that anecdotal stuff. What really matters is how quickly these restrictions are eased, how quickly people get back to work, how many people will be permanently unemployed following this, because the expectation is that a lot of these folks, 40 million in the US, will be able to recover their jobs once things open up again. And certainly there will be a lot of people who will fall through the cracks. And that's what's driving this unrest. Thanks for that question, Mike. And I'll hand it to Chris to talk about Arby.
Thanks, Steve. Sure. So the recent riots in the US, we feel are far less motivated by racial tensions, but they've certainly been exacerbated by economic anxiety. Steve said 40 million people don't have a job to go to tomorrow, so they're out protesting, also due to other factors. I think the lockdown frustrations are another one. the quantitative easing is very much driving the market. If we talk about the three things that move the market: earnings, interest rates, and risk. Earnings are a negative, risk is a negative, but the quantitative easing is more than offsetting those factors, driving asset prices higher. And that market performance belies the performance of the real economy. So looking at commodity prices, particularly oil, better reflect the level of real economic activity. In general, earnings in the first quarter were fine, but they captured but a few weeks of the shutdown, and we're expecting a longer period of shutdown to be reflected in the next quarterly earnings. But while a third of companies have withdrawn their guidance for the year, a lot of companies have also provided incremental updates demonstrating that while revenue, for example, at MasterCard, they provided some weekly revenue data. While it dropped substantially, it found the floor and is now demonstrating some gradual improvement. A significant source of revenue for card companies like MasterCard is travel and entertainment, and so that's almost absent entirely now, but will recover as the economies reopen. So finding a base at a new level and demonstrating some incremental improvement, those sort of data points are helpful for us as investors to identify the path forward. The first quarter results were perhaps helped by some spike or brought forward expenditure on IT to assist people working from home, and then from a consumer perspective, people hoarding products that really have just brought forward sales from future quarters. Even one of our investments, Mylan, reported a 5% revenue growth in the first quarter, and believe that almost half of that was from people pandemic buying or stocking up. So those sorts of sales are likely to be drawn from future quarters. Joe believes that next, consumers may start to substitute more expensive or branded premium products with no frills. So that's a theme we're keeping an eye on. In 2018, on the back of the trade war, the S&P 500 fell from 3,000 to 2,500. Following that, we rallied to nearly 3,400, and now we're back to 3,080 as of last night. A lot of the focus is on the US economy, but we need to keep that in context or in perspective. Half of the S&P 500 constituent earnings are from overseas. So they are sensitive to the policies and state of the economies abroad. So to that, China, which is this trade war tension, is speaking to the earnings, interest rate, and risks which affect equity prices. This is a flashpoint which adds to that risk profile. So the trade issues today are coming to the fore once more. We've got the 5G, Huawei, Hong Kong's independent or autonomous status and trade benefits with the US, and now more scrutiny of Chinese companies listed in the US following the potential fraud at this Luckin coffee business. China doesn't care. They continue to try and expand their influence and agenda beyond their shores. But the US is willing to go hard on this $40 billion a month trade deficit, which has persisted, and the phase one trade deal, it already looks like China is behind on their commitments to purchase certain value or quantity of US product. Historically, the US Treasury has been supportive of the trade deficit policy, exporting US dollars to purchase products manufactured abroad, I beg your pardon, has been at attractive financial terms, but those funds flowing back into the US or held by foreigners need to be deployed somewhere. And that has created bubble scenarios. Bubble cycles is another macroeconomic theme you will be familiar with. The dot-com bubble, the housing bubble, and education as well. So in the current climate, and with consideration of the risks attached to these bubbles, there is growing support from the Treasury to stop or curtail the significant trade deficit. And I would add to this that the Fed's program of almost unlimited, or could be unlimited bond buying and expanded quantitative easing also provides a default buyer of US Treasuries. So they can support the expansionary fiscal policy by tapping the Fed's balance sheet. Another area of risk are the BRICS, which are not managing coronavirus very well. And while these have been touted historically, BRICS refers to Brazil, Russia, India, and China. While historically these have represented high growth, emerging economies and garnered investor enthusiasm and attention, those potential tailwinds for investors now look to be headwinds. For the model portfolio, we have not made any changes this month. We continue to recommend a somewhat conservative positioning. We have technology stocks, healthcare, and a portion cash. So not dissimilar, perhaps, to what Thomas Lee at Fundstrat is advocating, something of a barbell. So with that, and unless you have any questions, I will review, Steve and I will review the stocks comprising the relative value portfolio. So Mylan is one of the world's largest generic drug manufacturers, and they are, believe it or not, trading at less than 4 times forecasted 2021 earnings. And as you can see by the relative value graph, they enjoy healthy profit margins around 20%, and they're trading at about 0.7 times sales. If you compare that to their peers and the average, it's a material discount. Now, the catalyst for unlocking value at Mylan is the combination with Pfizer's Upjohn business. Upjohn is Pfizer's generic drugs business, which has about 20 brands like Lipitor and Viagra. And by combining the two businesses, Pfizer and Upjohn and Mylan will greatly expand their global footprint. So it will offer scale efficiencies from a revenue perspective, and also cost synergies by removing duplicate selling, general and administrative expenses, and it'll also improve their presence in the higher growth emerging markets. In order to appeal to a dividend or income focused investor, the new combined entity will also be committed to returning capital, so a dividend and buyback strategy. So looking at Mylan and the new combined entity on a pro forma basis, Mylan represents about 5 times enterprise value to EBITDA multiple, with that EBITDA looking to grow pretty dramatically over 2 to 3 years as the cost synergies are realised. So we're sticking with it, and the catalyst is likely to be realised in the second half of the year. To Medtronic, another healthcare business. a company that I've often described as a ballast in our model portfolio. We see they enjoy very high margins, almost the highest in their sector, yet they trade at a modest discount. They're a very high quality business. They have, over the last 3 to 4 years, dramatically expanded their net profit margins, so driving operational efficiencies into their business, especially following the acquisition of Covidian and redomicile to Ireland for tax benefit purposes. They had a very good result this most recent quarter. The key takeaway is that while the coronavirus impacted their near-term revenue, it very much looks to be deferred, not cancelled. And Medtronic expect that all of the revenue that was deferred will be realised within the next year. So, also supported by their strong balance sheet and liquidity position, the near-term challenges have not derailed their longer-term investments in bringing new products to market. And for the 43rd consecutive year, they again raised their dividend. So again, that reflects the strength of the balance sheet and liquidity of the business. To technology, Intel, trading at about 19 times forecast earnings and right in the middle of the bunch there among their peers, as is Qualcomm, another relative value stock. Intel has, for the last 10 years, traded at discounted valuation due to their reliance on PC chips, which are experiencing a very slow, gradual decline trajectory. Meanwhile, what was a small component of their business, the data-centric segments, they have grown, and we're at the point now where they are set to eclipse the declining PC chips. So overall, the growth profile at Intel is greatly enhanced, and as we saw this most recent quarter, the accelerated adoption of laptops, which helped PC chips as people work from home, but also the cloud and enterprise servers have really buoyed their results recently. This isn't a one-quarter thing, though. This is a broader secular growth theme that will support Intel's earnings and revenue growth for years to come. And we think that in time, investors will appreciate that growth profile and ascribe a more appropriate valuation to the stock. And we like the analogy that Intel is to cloud providers what Levi's was to miners. Levi's supplied jeans and tools to miners, and their fortunes were mixed. Intel is providing their technology to the likes of Amazon and Alphabet, some of the largest cloud computing service providers, and it doesn't so much matter who takes the market leadership, if there are winners and losers. Intel is supplying them all and benefiting from that. And to Goldman Sachs. Goldman Sachs had their quarter was very different to a number of other US banks because they are not so much exposed to credit quality because they don't have a very big presence in Main Street lending. They are more of a Wall Street style bank, and they do have a great track record of navigating these sorts of crises and profitably so. So the first quarter, they had revenue growth more than 20% in their three main divisions, which included trading, debt and equity trading was the best and the second best quarter in about 5 years. Investment banking revenues and consumer and wealth management revenues also up more than 20%. They were caught in the downdraft of sentiment in the quarter, and the stock has subsequently recovered somewhat, yet it still trades at a discount to the net asset value or book value. I'll hand to Steve to discuss the remaining stocks in the model portfolio.
Chris. So there has not been a whole lot of news with our constituent holdings since the last presentation. That was really more interesting because we had earnings results, but Viacom is up 116% from the March nadir, and 26% in the month of May, so it was one of the best performers in the market. And that was really driven by earnings. We saw an inflection point with their streaming strategy, which is, a welcomed news. There's been fairly broad adoption of their streaming platform. The domestic streaming and digital service that they provide across several different platforms. They got Pluto, they have CBS All Access, they've got Showtime, rose 50% year over year. So just significant growth in streaming, which I think allowed investors to breathe a sigh of relief. It's still, even after 115% run-up, trading at 4.8 times earnings, which is ludicrously cheap. The one, if we were to point out one sort of negative with this firm, it's their leverage, but they've got plenty of free cash flow. They're projected to have $1.2 billion in free cash flow this year and $1.6 billion next year, so more than enough ability to service the quite sizable debt that the firm maintains. Electronic Arts is a good example of the rapid shift in consumer behavior to digital purchases. So they make video games and sell it through distributors, gaming shops that in the form of cartridges and also in digital form. And obviously a game that doesn't have to be manufactured and put into a cartridge and then sold through a distributor that creates a little margin. The digital product is much higher margin. You're seeing a big shift. So that drove earnings for first quarter, and really it was only reflective of about a month, the month of March that saw the rapid shift in digital sales. And we expect that the lockdown will continue to encourage consumers to shift the way they purchase stuff in general, but particularly for electronic arts products. And they have a good library of games that people like to play: Apex Legends, Sims, FIFA, all best-selling franchises. Alphabet, very reasonably priced for a large cap tech firm. They're about a $980 billion market cap, the dominant provider of online advertising and cloud computing. They are number 3 in cloud services behind Amazon and Microsoft. But what we saw in the first quarter was a 15% rise in revenue, which is in line with expectations, a 34% rise in YouTube sales, which was well ahead of expectations and much better than the previous quarter. And I think investors were relieved at that. But I think the more important growth came from their cloud division, which was 52% year over year. And that number demonstrates that they're gaining market share on Amazon, who's number 1 in the space with about $35 billion in annual cloud sales. Alphabet's at about 10 or 12 billion. But they had 52% growth in that division, while Amazon's growth has leveled out, grew at, I think, just sub 30%. So both Alphabet and Microsoft are taking market share from Amazon in the quarter. And at 21.5 times earnings, given its growth profile, we think is very reasonable. You would expect more money going into the large cap technology firms. It's a safe place to park money in this environment. Qualcomm, also one of the best values in the tech space, trading at 14.5 times earnings after last night's market move. They are the dominant provider of the technology that underpins mobile communications worldwide, but they are also the preferred provider of the architecture for 5G, now that Huawei has been essentially locked out of a number of markets worldwide, including the US, looks like the UK now, and Germany, and Australia. So Qualcomm will have a tailwind for about the next 5 years with the rollout of 5G. That's going to drive sales growth. Also with 5G, they can charge about 30% more for the technology in 5G handsets than they do for 4G. So we're just going to see an uplift in sales and profit with the adoption of 5G. What we've seen with the Chinese market, for instance, in the first quarter toward the end, channel checks indicated that handset sales, mobile device sales in China, had returned to pre-COVID levels, which bodes well for Qualcomm. At 14.6 times earnings, this is one of the best values in the tech space right now. And it's one of the only 5G plays that you can do with a large cap stable name. And with that, if there are questions, we're happy to field them. But the current allocation in the portfolio: 20% cash, Electronic Arts, Viacom, Medtronic, Mylan, Alphabet, Qualcomm, Intel, Goldman Sachs, and of course the BAT supplementals. So you want to move that so they can see the long-term track record? Oh, okay. Well, we're very proud of our long-term track record. We underperformed in the first quarter, but we've been outperforming for the last month and a half. And with that, we'll conclude the presentation, but we'll field questions if anybody would like to chime in. We'll stick around for a couple of minutes, just in case. Thank you very much. Okay, we'll wrap it. Thanks, everybody.
Thank you.
Thank you.